The S&P 500, the bellwether of the American stock market, has rallied nearly 10% over the past 3 weeks, following a dismal January and February. 3 weeks ago, the index looked like it was about to give up the ghost. And now, unbelievably, it is just 5% away from its all-time high. The renewed confidence in the U.S. stock market appears to have been inspired by the belief that the conflict in Ukraine will be short-lived, and that anyway, the U.S. will be relatively immune to its impact. This is why the U.S. stock market has outperformed the stock markets of the rest of the world by 10% since Russia invaded Ukraine, and why the U.S. dollar has likewise outperformed nearly every major currency in the world, including safe havens like the Japanese yen and the Swiss franc. Is the market right to assume that the US will ride out the Russia-Ukraine war better than anyone else? Is the big rally in US stocks supported by US fundamentals? Or is it just a dead cat bounce? Welcome to part 1 of The Money Game, where I take on groupthink, propaganda, and conspiracy theories in my critical analysis of markets, economics, and politics. In today's video, I will talk about why I think the stock market is wrong to assume the US economy will be resilient to the war. I will argue why the recent stock market rally is unsustainable, especially if Washington fails to pull off a regime change in Moscow soon. The war started in late February. Last week, we got the first batch of US economic data for March, the first full month after Russia's tank rolled into Ukraine. What does the data tell us about the US economic response to the war so far? The new orders component of an important survey of purchasing managers in the manufacturing sector, an excellent leading indicator of the US business cycle, fell sharply to the lowest level in 2 years. This is consistent with reports that Apple is cutting production of the iPhone SE by 20% next quarter. Meanwhile, a widely followed US consumer survey showed a sharp drop of consumer confidence in March to the lowest level in more than 10 years. Last week, we also got the preliminary estimates of US corporate income data for the end of 2021. It shows that even before there was even a hint of a war coming, the growth rate of US corporate earnings had already gone to 0. And yet, the data also shows that corporate profit margin at about 15% was still very high, near the highest level in 20 years. Profit margin measures what companies charge for the goods and services they produce versus what they have to pay for producing these goods and services. The question is whether this fat profit margin, 15%, is sustainable. Looking at different factors, I think not. Let's examine first the revenue side of the equation. The pricing power of corporate America got a huge boost last year from the massive handouts to US households by the Biden administration that sent Americans on a once-in-a-generation shopping spree. Consumer demand was so strong that companies had no problem passing higher costs to their customers. On the cost side of the equation, the price of industrial raw materials continues its relentless rise, pressuring the margins of a wide range of manufacturers from car companies to detergent producers. The CRB Raw Industrials Index, that includes everything from cotton to rubber to steel, has been rising at an annualized rate of 24% so far this year. The cost of labor, which is about 60% of the overall cost for average American corporations, but higher for service providers, is rising at a rate of 6%, the fastest in 20 years. With 10 million unfilled jobs and the unemployment rate now at just 3.6%, workers are regaining their wage bargaining power. Last week, the workers at Amazon's Staten Island facility made history, voting to become the first unionized U.S. facility operated by the largest e-commerce company in the world. Amazon will fight the decision, but this looks like a broader trend that is here to stay. This is undoubtedly bad news for Amazon's corporate profit margins. Meanwhile, the interest cost for financing and refinancing long-term debt is going up quickly. This will also pressure corporate profit margins. Some banks have even started to tighten lending standards. I can only assume, based on the above factors, that U.S. corporate profit margin has likely peaked. It seems reasonable to think that it will at least fall back to the pre-pandemic level. This will represent a 2.5 percentage point drop. And if this happens rapidly, we could see a 15% drop in corporate earnings. This does not even assume we go into a recession and revenue drops. Yet the consensus on Wall Street is that while earnings growth will slow this year, it will still clock a respectable growth rate of 9% on a post-COVID bounce in demand. In my view, Wall Street is drinking its own Kool-Aid. The only way Wall Street analysts could be right is if the war in Ukraine ends soon and the sanctions against Russia are rolled back immediately. But as I've argued in last week's program, is Putin done for? I believe that the war in Ukraine will not end anytime soon. While Washington is aiming to achieve a regime change in Moscow, Putin's decision to pull back from Kiev signals that he's planning to dig in the east for an extended conflict. In fact, the latest reading from the Rewi Unbound Military Conflict Risk Survey shows that 70% of Russians and 60% of Ukrainians think that military tension is likely to either remain the same or intensify. In any event, the impact of the war on the U.S. economy comes not from the fighting on the ground, but from the sanctions. Even if the fighting were to cease, as long as the sanctions remain in place, the economic pain for the rest of the world, including the U.S., will not end. The most important headwind from the war for the U.S. economy is the increase in oil price that is sapping consumer confidence and consumers' real purchasing power. Last week, Biden decided to deal with this headwind by releasing 150 million barrels of oil from the U.S. Strategic Reserve over the next 6 months. This is an unprecedented move. But will this be sufficient to support corporate profit margins in the U.S. stock market? In my view, Biden's move is unlikely to have a sustainable impact on the oil price. The timing as well is indicative, as it could be telling us that the U.S.-Iran nuclear negotiations are not going well. Releasing the U.S. reserve will also strengthen OPEC plus incentive to increase production more quickly. The longer the war drags on, the impact on the U.S. economy, on U.S. corporate profit margins will become more visible. I don't see the war ending in the near horizon. I certainly don't see the U.S. removing sanctions on Russia anytime soon. To the contrary, the evidence at hand suggests that the conflict is intensifying and broadening, with growing risk that China will be dragged in. Against this backdrop, I think Wall Street will be soon forced to revise down its forecast for both the U.S. economy and the U.S. corporate profit outlook. My expectation is that the forthcoming U.S. corporate earnings season could provide the catalyst for this. If I'm right, April will not be kind for S&P 500. The price action in the financial market last week was interesting to watch, as it says a lot about how investors are thinking about the global economic outlook. S&P 500 was flat on the week, but if it weren't for money chasing the defensive sectors like utilities, staples, and health, the market would have finished the week in the red. Indeed, the cyclically sensitive sectors like financial, energy, industrials were all down on the week. This makes me think that we're closer to the end rather than the beginning of this dead cat bounce. Real estate was the best performing S&P sector last week, despite the fact that the effective 30-year mortgage rate hit a new year high at 4.96%. Amazingly, real estate is up 12% since the Russian invasion. What do investors see in real estate? I think it has much to do with stagflation becoming a fashionable investment thesis. The consensus is that real estate is a good stagflation hedge, as real estate should track nominal income rather than real income. The fact that speculators are as long gold as they are short 10-year U.S. government bonds right now is also consistent with the stagflation thesis. Inflation is bad news for nominal bonds, but good for real assets like gold. Even though 2-year, 10-year part of the U.S. yield curve briefly inverted last week, the market does not seem to be too concerned about the risk of a recession in the near future, at least not in the next 2 years. The Fed funds futures curve is straight up until the end of 2023. Even after that, it does not look like the market is genuinely contemplating a recession-inducing easing cycle. Meanwhile, the fact that European stocks did well last week suggests that investors want to believe that something good will come out of the meeting between the Russians and the Ukrainians in Turkey. The fact that Chinese stocks also had a nice week shows that investors want to see the shutdown in Shanghai as glass half full rather than glass half empty. All in all, the price action suggests that the market is much more worried about upside risk to inflation than is worried about downside risk to growth. I am obviously in the other camp, given my view about the war being here to stay and my concern that Washington could potentially impose sanctions on China. I also don't like the fact that TSMC, the largest chip foundry in the world, warned last week of softer demand for smartphones and PCs. Given the above, I'm going to establish a long position in 10-year U.S. government bonds via IEF. I will start with just 1/3 of the position I plan to build on Monday at the open. I'm also staying with my S&P 500 short via SPXU. For my 40-60 portfolio, I'm going to stay max underweight equity, but go medium overweight bonds 10 percentage point for next week. Now let's bring John in to see what he has to say about the market. Hi, John. So tell us, what was the one thing that caught your eye last week? And also give us a quick summary of our portfolios. And finally, what should we be looking out for in your next more buyers than sellers coming out tomorrow?
Thank you, David. So what really caught my eye this week was the big divergence between the front end and the back end of the rates curve on Friday. Now the 5-year point sold off by more than 12 basis points, and yet the 30-year point actually rallied by more than 2 basis points. Now that magnitude of divergence doesn't happen very often. In fact, the last time was in June 2008. And it's actually quite interesting. If you compare the equity market back then to the Qs right now, it's very, very similar. So it just completed the first big bear market rally, and they were just rolling over. And of course in 2008 it was downhill all the way from there, so we'll see how it turns out this time. Now the rally in the long end of the curve was good for our bond portfolio. We were long TLT, so that gave us a nice gain there. The 60-40 in the sector portfolio, they were both kind of flat, not very interesting. Now coming up in more buyers and sellers this week, even though we think that there's a good chance that the equity market goes, we're still not planning to sell any of our equities. Why might that be? Also, we ask ourselves, what's the easiest question we can answer to make ourselves better traders?
Thank you for that. On that note, talk to you guys next week.